As you see the makeup of this market change a bit, right? NVIDIA cool down and some of these other areas pick up. What are you thinking?
I'm thinking this is a healthy development, quite honestly. We've seen a lot of focus on the outperformance of the Magnificent Seven. And as we know, some of the Magnificent Seven haven't been so magnificent recently. And if some money comes out of the Magnificent Seven and spread more evenly across the rest of the market, that would be a healthy thing. For example, the S&P equal weighted index has recently gone to a new high, which is a good thing. So I think that a broadening of the market is probably what's in store. And I think we're also likely to see less momentum. I just looked at the latest Investors Intelligence bull-bear ratio, and it's off the charts. It's not completely off the charts, but it's up to 4.2. It can go higher. It has gone higher in the past, but this is up from 0.56 right at the bottom of the of the bull market, right when the bull market just started. The sentiment was horrible. Now everybody's bullish, and that means there may not be enough bears around to convert into bulls to keep the momentum going. So I think we're going to see some weakness in the momentum trade and more of a spreading of the market to other sectors and industries.
It's interesting you say that. I was going to ask you whether you feel like you still have to prove to people that this is, in fact, a bull market that's not close to being finished yet.
Well, I think we're way past the point where I have to prove that this is a bull market. I think we all know it's a bull market, but look, bull markets can last a long time until we get hit by another recession, and that requires the Fed to be raising interest rates. I didn't anticipate a recession over the past couple of years. We just went through an environment where we had the most widely anticipated recession of all time, so it turned out to be a complete cadeau, complete no-show. And I don't see a recession this year or next year. I mean, the Fed has already raised interest rates. I think inflation has come down. I think it's going to stay down. You know, excluding shelter, the CPI inflation rate is already at 2%. You know, when you have kids and you go for a drive and they say, are we there yet? Well, we're there, except for shelter, and shelter's coming down. Shelter inflation's coming down. So I think it's a long-term bull market. I got still 5,400 by year end. That was a pretty bold call off like a year ago, but
it was.
Right now it's looking pretty conservative.
Yeah.
And why not more? I mean, people ask me, why aren't you raising your numbers? And so, well, you know, there are kind of limitations in terms of what earnings can do and how much higher valuation can go. But I see 6,000 next year on the S&P 500 and 6,500 after that.
And do you dismiss the inversion of the yield curve because the Fed's going to be cutting rates and thus you'll have a re-steepening? How do you view that?
I wrote a short little study that's on Amazon. I'm not promoting it because I'm going to make any money on it, but because in 2019, Melissa Tagg and I, my colleague, we wrote a piece on the yield curve and what does it really mean? And this notion that an inverted yield curve means that we're going to have a recession, I think misses an important point. And what it really does is it predicts a process. It predicts a process that if the Fed continues to raise interest rates, something will break in the system, and that will lead to a credit crunch. And it's credit crunches that cause recessions. Well, the yield curve got it absolutely right again. And we did have a financial crisis last year, but the Fed came in and played whack-a-mole. That liquidity crisis, they whacked it right down with the liquidity facility, and we didn't get a credit crunch, so we didn't get a recession. So as long as we don't get a credit crunch and not a recession, I think the bull market continues.
I mean, you've never had a recession without an inverted yield curve, but an inverted yield curve alone doesn't mean you're always going to have a recession. I think that's the fair way to say it, but it's been inverted for so long that, you know, people are still at the stage of, well, I got to keep my eye on that because the yield curve has always meant something, and the bond market has been right many times, as you obviously know.
Yeah, well, I've been fighting the inverted yield curve story. I've been fighting the leading indicator story. I think the leading indicators really are an indicator of what's going on in the goods economy, much more so than in the services. And the inverted yield curve, again, I think it got it right in terms of calling a financial crisis. But the Fed this time around did something different, which it hadn't really done before, and that is it came in with liquidity to keep the financial crisis from turning into a credit crunch. I really should correct myself. I mean, the Fed got a lot of experience dealing with these credit crunches and avoiding them back in 2008, 2009, and again in the pandemic. So they're pretty good now at playing whack-a-mole with liquidity crises.